$15 billion. That is what American banks pulled in from overdraft fees last year, and most of that money came from customers who were short by less than $50 when it happened. Not by accident, by design. Somewhere inside your bank's system, there is a piece of code built specifically to decide the order your transactions post in, and that order can be the difference between one overdraft fee and 4. Stick around, because by the end of this, you'll know exactly where your bank hides its profit, and you can tell me in the comments which one surprised you most. Walter had been banking at the same branch for 22 years. Same teller line, same free coffee out in the lobby, same guy behind the desk who called him by his first name every time he walked in. He trusted that place the way you trusted a neighbor you've waved to for 2 decades. So when his account got hit with 3 overdraft fees in a single week, he figured it was his own fault. He'd been careless. He'd lost track of a few small charges, and the bank was just doing what banks do. That's the story most people tell themselves, and it's the story banks are counting on you to believe. Because the truth is a lot less forgivable. Walter's bank didn't process his charges in the order he made them. It processed the biggest one first, on purpose, which flipped 3 small purchases from covered to overdrawn in a single afternoon. One rearranged list of numbers, and Walter went from fine to charged $98 before he even knew what hit him. That single trick, reordering your transactions from largest to smallest instead of the order they happened, has cost Americans billions over the years, and lawsuits have proven banks knew exactly what it did to their customers. Some banks got sued and settled for hundreds of millions of dollars, quietly, without much news coverage, because a quiet settlement doesn't hurt the brand the way a public trial would. But knowing about it is only step 1. The real question is why banks are allowed to build a system this way in the first place. And once you see that answer, you start noticing it everywhere else in how they handle your money. Walter didn't know it yet, but the overdraft fee was the smallest example of a pattern that ran through nearly every account he'd ever opened. If you've made it this far, you're the kind of person who actually wants to know how this stuff works, instead of just complaining about it after the fact. So go ahead and hit subscribe, because the next few things I'm about to walk you through are the ones your bank really doesn't want spreading around. Walter started digging after that overdraft mess, mostly out of pure frustration, and what he found made him feel less like a customer and more like a product being managed for maximum profit. The second thing he found was dormant account fees. Banks are allowed to charge you a monthly fee just for not using an account, sometimes as little as $5, sometimes closer to $20, and it kicks in after a stretch of inactivity that varies by bank but is often somewhere around 6 months to a year. Walter had an old savings account from years back, opened for his daughter's college fund, that he'd stopped checking once the tuition bills were paid off. 3 years of silence had quietly drained almost $400 out of that account in fees, and nobody at the bank called to warn him. Why would they? Silence is profitable. An account nobody watches is an account that slowly empties itself while the bank collects the difference. And if the balance ever hits 0, they simply close it and keep whatever came out of it in fees along the way. The third thing runs even deeper, and it has to do with what your bank actually pays you for the privilege of holding your money. Most savings accounts in this country pay under 0.5% in interest. Meanwhile, that same bank turns around and lends your deposits out as mortgages, car loans, and credit lines at rates 5, 6, sometimes 10 times higher than what they're giving you. That gap between what they pay you and what they earn off you is called the spread. And it's the entire foundation of how a bank makes money. You are, in a very real sense, lending your bank money for almost nothing so they can lend it back out to someone else at a serious markup. Walter had $40,000 sitting in that low-interest savings account for years, money his bank used to fund loans that earned them thousands of dollars a year, while he collected less than the cost of a couple tanks of gas. He wasn't being punished for anything. He was just an average customer, doing exactly what the bank hoped he'd do. Leave the money there and never ask questions. But none of that compares to what Walter found next. And once he understood it, he couldn't look at his bank statement the same way again. Every bank in America operates under something called fractional reserve banking, and here's the part that actually changes how you should think about your money sitting in that account. When you deposit $1, your bank is not required to keep that whole dollar sitting in a vault waiting for you. It's allowed to lend out most of it, keeping only a small fraction on hand, and that fraction has gotten smaller and smaller over the years through regulatory changes most people never heard about. That means the balance you see on your banking app isn't a stack of cash with your name on it in a vault somewhere. It's a number the bank owes you, backed by a system built on the assumption that not everyone will ask for their money back at the same time. Most days, that assumption holds up fine. But it's the reason banks can fail so suddenly when trust breaks, the way we saw happen with a handful of regional banks a few years back, where deposits vanished from public confidence in a matter of days, even though the underlying money had been loaned out long before anyone panicked. This is also where FDIC insurance becomes something you actually need to understand instead of just glancing past. The government insures your deposits, but only up to $250,000 per depositor, per bank, per ownership category. If you and your spouse have $300,000 sitting in a joint account at one bank, and that bank collapses, you are not fully covered. A lot of people assume the government backs every dollar in a bank no matter what, and that assumption has cost real families real money when a bank went under and their balance exceeded the insured limit. Walter, thankfully, never had that much sitting in one place. But when he found out the limit existed at all, he realized he'd never once been told about it by anyone at his branch, not in 22 years of loyalty. Then there's the part that made Walter the angriest, because it felt the most personal. Banks routinely run soft credit checks on existing customers without asking permission first, checking your credit profile to decide whether to raise your credit limit, lower it, close a card, or target you with a loan offer. It doesn't hurt your credit score the way a hard inquiry would, but it does mean your bank is quietly watching your financial life behind the scenes, deciding what kind of customer you are and what kind of offers you deserve, all without a single conversation. Walter's credit card limit had been cut in half 2 years earlier, right after he'd taken out a car loan elsewhere, and nobody ever explained why. He just got a letter in the mail one day, informing him after the fact. There's also the fine print buried inside free checking accounts, the kind that only stay free as long as you meet a minimum balance or a minimum number of direct deposits every single month. Fall below that number even once, even by a few dollars, and the fee kicks in retroactively for that entire month. Millions of Americans are paying monthly maintenance fees on accounts they were told were free, simply because their paycheck landed a day late or their balance dipped under the line for one afternoon. And early account closure fees work the same sneaky way. Close a checking account within the first 6 months of opening it, sometimes even the first year, and plenty of banks will charge you $25 just for leaving, framing it as a service fee even though the only service involved was you deciding you'd had enough. The last thing Walter found, the one that finally pushed him to switch banks entirely, was what happens to forgotten money after enough time passes. If an account sits untouched long enough, depending on the state, that money doesn't just sit there forever. It gets swept away through something called escheatment, transferred to the state's unclaimed property division, and your bank is legally allowed to hand it over without much more than a notice mailed to whatever address they have on file, which is often years out of date. Once that money reaches the state, getting it back means filing a claim, proving your identity, and waiting, sometimes months, for a check that used to just be your account. Billions of dollars are sitting in unclaimed property offices across the country right now, waiting for people who have no idea it's even there. Walter ended up leaving that bank after 22 years. Not because one thing broke him, but because 8 small things stacked up into a pattern he could finally see clearly. None of these things are illegal. That's what makes them so frustrating. They're legal, they're disclosed somewhere in pages of fine print nobody reads, and they rely completely on you never asking the right question at the right time. The system isn't built to rob you outright. It's built to profit quietly off the parts of your financial life you're least likely to check. The good news is that once you know where to look, almost every one of these fees or tricks can be avoided, sometimes with nothing more than a 5-minute phone call or switching to a bank that doesn't play these games in the first place. Knowing the trick is most of the battle, because a bank can only profit off what you don't notice. The moment you start noticing, the leverage shifts back to you. So here's the one thing to actually do with everything you just heard. Pull up your own bank statement tonight before you forget and check it against these 8 things one by one, because there's a good chance at least one of them has already cost you money without you realizing it. And if you want to know exactly how to structure your accounts so none of this ever touches your money again, that's coming in the next video, and trust me, it changes how you think about where you keep your paycheck for good.